Everyone, welcome to the Leadership Blueprints final webinar. And in this basically presentation, we'll go through and summarize all the key concepts that you should have learned in Leadership Blueprints with new examples to really explain and drive home all the key ideas of the course. So if you can go to the next slide, Ray, and we'll get into the presentation and talk about kind of an overview of what we covered. So obviously, first of all, we talked about some basics to make sure you guys can understand the more advanced topics in the course. What moves the market, what are institutions buying, price and volume basics, how to interpret price and volume analysis, support and resistance, what are bases, base stages, and also Stan Weinstein's stage analysis, which we're calling stock phases, just because it's a little bit easier to kind of differentiate between stock bases if we call it phases. Then we'll drive into subtle accumulation, visible accumulation, and also how to develop your conviction using price and volume analysis. Finally, if we go to the next slide, we'll talk about how to effectively use key moving averages, what moving averages do we use, what it means to respect a moving average, and how to use the launching pad or looking for moving averages bunching up under the price. Finally, we'll talk about weekly charts, tell the best story, how to interpret weekly charts, how William O'Neill did it. And finally, we'll talk about identifying distribution, both in terms of distribution days, breaking key moving averages, climax tops, and also late stage base failures. So diving right in, let's go ahead and talk about what moves the market. And Ross, I'll hand it off to you.
Okay, so to get very basically, 3 out of 4 stocks follow the direction of the general market. So when I'm using, Bill's philosophy, I always look at it like the Russian dolls, from the biggest doll down to the smallest doll, the biggest doll being your market. Without sustainable uptrend in place, making progress is going to be very difficult no matter what's going on out there. Especially, being in chop is one thing and very difficult to navigate, but when you're in a downtrend, you might as well forget about it. It's you're hopelessly swimming upstream and losing progress along the way. At the end of the day, the odds are completely against you. Also, it's important to keep in mind that institutions, the large institutions, banks, insurance companies, mutual funds, hedge funds, trusts, what have you, account for 70% plus of that true market volume. What's real, they are what moves the market as well. Right. So that's also extremely important to keep in mind. We'll get into that, in detail. And as you know, that is something we discussed in detail throughout the length of the course. So that's, kind of big and small picture there. But anyway, once we know that the market is in an uptrend and we're swimming with the tide, we've got 3 out of 4 stocks working with us. That's when we move down to our next smallest doll, which would be stock sector and industry group, which has a huge effect on a stock's price. As you can see, just shy of 50% of a stock's price is directly related to its sector and industry group, exactly 12% to its larger sector, and 37% based on its actual individual industry group. And, we'll get it. That's another thing we get more into in depth there, but you've got the uptrend. That's your biggest doll, your second biggest doll. Now we're honing in on the strongest sectors and then the strongest industry groups within those sectors as and you'll see move along here to the next smallest dolls, which will be, the individual stocks within those industry groups and what it is telling us. So we're not going to get into that now, but that there's a whole lot of information that can be gleaned from the type of stocks that are popping up in our scans and exactly how they're performing relative to the rest of the market and each other.
So just to add to what Ross is saying here, the goal of this course has been to identify what institutions are doing, given the fact that 75% of the market volume that we see day to day on a day-to-day basis is from institutions themselves. The goal of this course was to really, put into words what exactly is it, or how do institutions show up on the chart. So as we go through this webinar and as you've gone through this course, that's really been the goal, is how do we identify institutions on the charts themselves?
All right, so moving on, we're now going to focus on exactly what it is that the institutions are buying in the market. So we have now figured out what are the stronger sectors and industry groups. And so it's time to figure out what individual stocks in those groups that the institutions are going to be focused on. So this is the basis of how we at Trader Lion hone in on exactly what those companies are. It's William O'Neill's methodology, which, as we all know by now, is represented by these 7 letters, the most common characteristics to the biggest winners before they began their move over every market cycle. Listen, at the end of the day, the institutions want the companies with the newest, soundest, best product that can, at the end of the day, earnings. What's making the most money, what's growing the fastest, and what can sustain it. On top of that, as you know, this course is highly focused on institutions. We can, what represents that? Well, we're going to see there from volume. Volume is obviously one of the key ways to spot it at the end of the day when a bunch of institutions are all piling into a stock, that elephant splashing into the bath. It's really hard to hide the mess or the footprints that are left behind. And typically that doesn't just happen for a little while. Once some of these larger institutions start buying and their pals join along with them, it can take weeks or even months plus to, ultimately accumulate a position, which is why we're so focused on not only what the institutions are buying, but what the best guys on the street are really focusing most of their buying power in. Where do they see that growth? And ultimately, we're riding the institution's coattails. And we're spies. We've figured out what it is that they look at, and we are ultimately putting it all together to figure out when they're piling into a stock and trying to figure out, obviously, as close to the top when they figure that elevator ride is over and it's time to get off without losing too much altitude. So we're never going to buy the bottom. We're never going to sell the exact top. Sometimes when we get lucky in certain situations, we may get close, if not spot on. But in general, the idea is to get, get in somewhere near the bottom where your risk reward is much better than at the dead bottom, and hence, get out as we're spotting distribution and institutions starting to bail out.
So just to add to what Ross is saying, basically the cancel methodology, what it does for us is it narrows our field of vision, where we're not looking at all 4,000, 5,000 tickers in the market. What the methodology accomplishes for us is it gives us the stocks with the best earnings, gives us the stocks with the, making new highs. There's the supply demand characteristics are there. They're leaders in what they're doing, and in their industry groups. They're really innovating. They're doing something that's different from, the rest of the companies. And the last piece of the canceling methodology, which is really the most important, is you want to be on the right side of the market. The canceling methodology itself is a proven methodology, even when it was put through its paces with external reviews, things of that nature that were done. So this is just a framework that allows you to narrow your field of vision so you can focus on the best of the best of the best. And what we've found is, and we approve of that as well, is many of the stocks that go 10-fold, 20-fold over a span of, a decade or multi-year runs, they exhibit these characteristics as well, which is why we've chosen this sort of methodology to make sure you guys know about it in the course before we move on.
And moving on to the price and volume basics, we'll start, of course, with an open, high, low, close bar. This horizontal line is the open. This one is the close. And where this open and close are relative to each other and within the range of the bar is what is extremely important. That tells you kind of how strong the buying pressure versus selling pressure is. And I view each of these single bars, whether they represent a minute, 5 minutes, a day, a week, a month, a year, as a kind of match of tug of war between the buyers and the sellers. And whoever wins is basically the winner is determined by this closing range, which is the close minus the low divided by the high minus low. For instance, this bar right here, the close was pretty much right near the top of the trading range. So this would have basically a 95% closing range. And the expectation from a strong closing range like that is that the momentum is strong and it will continue within the next few bars. Now, that's just the expectation. Obviously, we take it one bar at a time, one day at a time, and reframe what we think about momentum and whether the buyers or sellers in control based on that new information and, of course, the context of the overall trend. So that's pretty much it for the very basics of price and volume. And we'll move on to a little bit more advanced topics here. So first up, we've got, of course, strong closing ranges, which I just mentioned, especially when it comes on very high volume days, as we can see down here. And this is Zscaler from 2020. And this was with an earnings catalyst. We see a very strong close here on high volume after gapping up. Definitely a sign that institutions are involved, especially because if we look at the moving average of volume down here, you can see that on this day, we traded 22.5 million shares, while the average was about 4.5 million. So quite a bit more shares were traded that day, which is a sign of institutional activity. And we didn't just have that strong action on one day. Instead, we had a very strong follow-on day with, once again, a very strong closing range with the close right near the top of this bar's range. And then we consolidate for a few weeks. And then I think from this point, we increased 70, 80%, basically because institutions aren't just accumulating shares on these 2 days. They require weeks, months, even years to accumulate the positions that they want. And that basically drop in supply means that just a little bit of demand can rapidly increase the stock's price. And that's when we want to get involved.
And one of the things that we feel that is very important, and the reason we keep saying the word closing basis is we want to see where the stock ends up on an end of day basis. So even though a stock that opens lower or fades its intraday gains and closes strong on the day, from a daily point of view and on an end of week basis point of view, that close is very important. So from the key takeaway from the price and volume basics is we're focusing in on where the stock is closing. At times you will see stocks open weak but close strong on the day. That's basically telling us that institutions, there's still accumulation in the stock. So if a strong close is always significant of accumulation in a stock on a day-to-day basis. And that's exactly what you want to see, especially in this particular example where ZS gaps up and also closes up with a strong closing range. That tells you there's a lot of buying in the stock itself. There's a lot of accumulation of the stock on those 2 particular days.
And I think it's also worth mentioning that time frame matters, and the higher the time frame, the more important. So a hourly bar is more relevant than a 5-minute bar. A daily bar is more relevant than an hourly bar, and of course, the weekly, monthly, yearly, those are more relevant. So as the time frames increase, that institutions and the net result of the buying pressure and selling pressure shows up more on those higher time frames. So moving on to low closing ranges, this kind of follows the same kind of expectation. Here we have closes near the low of the trading day on this stock AYX from this past year. And this is a sign of distribution. We have high volume down days with low closing ranges. You can see the down volume right here, once again, above average. And this basically means that there was some distribution by institutions, especially because we have a gap down. And this is not what you want to see when you're owning stock. This is a little bit of a warning sign and basically an indication of distribution by institutions. Once we have a couple of these bars in a row, the expectation is that the momentum will fall to the downside. And we see that here on the chart, we decrease from the 100s down all the way to the 70s at the bottom of this chart. And moving on, once again, to strong closing ranges, it's also important to consider what happens after that first day, because one day does not make a trend, but you have to kind of take every new day and that new information and reframe what you're thinking about. And this on actually another earnings gap up of ZS is exactly what you want to see if you don't see kind of fall through days. Very tight action inside bars, low volume, meaning supply is once again still being absorbed. So even though we didn't fall through to the upside, there's still no real signs of institutional distribution. That would show up like a bar. If you think of this arrow as a bar, if we undercut the low of this earnings gap up day and fell back into the base, that would be a sign of distribution. But instead, let me go ahead and clear that arrow. We have tight price action, and basically a sign that institutions are basically accumulating any kind of weak holders who are distributing stock. That supply is being absorbed by those institutions. And once again, the stock made a strong move out of this earnings gap up. And moving on to another really key concept, relative strength. We can see that on weekly charts, especially during a March correction. During these corrections and bear markets, it's actually a lot easier to see relative strength because the stocks that are being supported by institutions are really standing out on the charts by their closing ranges, by their volume and price action. So first things first, we've got NVIDIA during the March 2020 correction. And the first indication of relative strength is the strong closing ranges, meaning that off the lows, the stock was supported strongly. And you can see that all of these closing ranges on this week, and this week were above 40%. And during a correction, that's a sign of institutional accumulation. And the second really key concept here in terms of relative strength is look at the RS line. This is actually an uptrend while the stock is declining because the overall market is faring worse than this stock. So once again, a sign that institutions are supporting the price action. And if you're not familiar with what the RS line is, it's basically the stock's price divided by the price of the SPX. So the actual value has no relevance, but the trend of that line, and in this case, we've got it represented in bars, is extremely important, especially during March corrections. This is key. If you see a RS new high before price, that's kind of the holy grail when it comes to identifying potential new leaders during the next uptrend.
And one of the things that's also important on this chart is to take a look at the fact that we're using a weekly chart when the market goes into correction. It's very important to sort of zoom out, especially during phases where the market is correcting, to actually see the accumulation that's taken place, especially on NVIDIA here. Given the fact that on a weekly closing basis in a market correction, we're seeing NVIDIA close up in the upper half of its weekly range. That's significant, and that's really what allows the RS line to uptrend, because what's happening is the market's in a downtrend. NVIDIA is trying to push and fight in the opposite direction. It's trying to basically say that it's trying to hang in there while the market needs to do what it needs to do to basically go through a correction and then resume another uptrend. So using your weeklies with your dailies is also important, and it will give you a complete picture of what a stock is trying to do, especially during a corrective phase.
I was going to say, is it fair to say that that relative strength line is a visual representation of exactly that simple formula that Richard talked about, right? There's no inherent value in the price divide, NVIDIA's price divided by the price of the S&P. But again, it's basically a visual. It shows you without having to analyze week by week that those closing ranges are, much tighter than the, it's a constant relative measure of, the strength of NVIDIA versus the relative, strength and closing range of the S&P. So as that, it's going to clearly pick up any, so when we see those pink days that are actually more indicative of accumulation than distribution, even though they're big and wide and pink, it's going to get picked up in a hurry in that RS line.
Absolutely. And just to reinforce, Ray, if you could go back for just a second, just to reinforce what Ross was saying, you might think that because of this high down volume, this is distribution, but really because of the closing ranges, the strong action, the tight action, this volume is a sign of accumulation, subtle accumulation. So don't take every down day as a negative. Take into account both the price and volume action together, and especially over the course of many weeks, allow that to form the bigger picture. Also taking into account the relative strength line in determining whether something was accumulation versus distribution. And moving on to breakout failures. Once again, this is all about expectations. When a stock is breaching a significant point of resistance, we want to see follow through. We want to see strong moves up on volume, indicating that institutions are supporting the stock and causing that breakout. However, this is the exact opposite. This example is the exact opposite of what we want to see. And I kind of made an example earlier. This bar takes out the high, fakes everybody out. We think it's going higher, and then it breaks expectations, takes out the low, and actually moves below this kind of consolidation here at this low. So this is a complete change of character. And you can see that the volume on this distribution bar is much higher than the breakout itself. So this is a failed breakout. You want to cut your losses quickly here and make sure you're not involved, because this, even though it bounces here a little bit, a bar like this can easily indicate the start of a downtrend because it's such a significant change in character. And you don't just see it in the price action, you also see it in the RS line. There's a change in character relative to the market, not just relative to the stock. So if a stock breaks out and has a strong closing range on volume, what your expectation should be, doesn't mean it has to happen, is either a tight inside day, just a slight pause absorbing supply before the trend continues, or ideally a bunch of up days in a row on volume, indicating that institutions are supporting that breakout. And now moving on to another important concept, we've got support and resistance. And in this case, we're looking at horizontal levels. So looking back at the left side of a chart, you want to identify significant points where a stock moved up to and then bounced and was rejected. And that is basically a point of resistance. So right here on the chart, this is an example of a resistance level. And you want to pay special attention when a stock revisits that level in the future, because it can either act as resistance again, or if institutions are strong enough and enough accumulation has happened, we can have a breakout like we saw with Square here in 2020. And this is a longer term base right here, a longer term consolidation with institutions accumulating supply. And once we have a true breakout, then the stock can really increase dramatically because we're in new all-time highs. The supply and demand characteristics are favorable for basically any new demand is going to rapidly push up the stock's price. And then after this breakout, we have a slight drift back into the pivot, into the significant resistance level. And we can see that now that point has shifted from resistance to support. And once the stock reclaims that level, it's off to the races and a very strong uptrend resumes. So that's the key thing with horizontal levels. Be on the lookout, look to the left on the chart, identify those important points like previous base pivots, previous all-time highs, all those very significant levels that traders, institutions, investors basically put a lot of meaning on that specific price level.
In addition to what Richard just covered, what's important, and I see many traders get hung up on, is the fact that why is Square not just breaking out and just going like that, right? What's the reason? The fact that we broke above resistance, why is it going sideways? And you have to keep in mind that basically what a chart is, it's a bunch of emotion, right? Where if a buyer that was basically accumulating in this spot sort of got hung up and caught in a downdrift, we basically have similar, when we get right back up to the point of resistance, which is this prior resistance, price is allowed to sort of fluctuate up and down, up and down, up and down, and sort of make a decision or make a final decision before it picks a trend up or it picks a trend down, right? So the fact that we see this sort of sideways action, and there's no such thing as perfection where we draw a line on a chart and it has to respect that line. There's no such thing in the markets because it's collective emotion. Traders that are trying to get in at this point are running into traders that may be holding up the stock below it. They were holding this whole way, the whole time. Now they're breaking even, and that emotion of breaking even is allowing them to sell stock, which is the reason why we don't just see a rise up straight through the highs. So nothing in the market is going to be as perfect as a horizontal level. This is just the key place that, the stock was at this level a couple of months ago. Market went through a correction. Now the stock is back up at this level, and there's going to be a negotiation that takes place before it could pick a trend up or it could pick a trend down. So interpretation of how the stock got here, it has it shown our relative strength days in this zone or this zone? Is there how are the price and volume characteristics shaping up? Is the volume drying up as there's a fight between the buyers and sellers at a key prior high? So when we talk about horizontal levels, it's not just you draw a line and you sort of say it has to go up from here. There's no guarantees in the market. It's just that this is a key pivot that represents prior emotion, because anybody that was long at this point probably needs to make a decision if they want to at this point. So you have to keep in mind that even though we're talking, horizontal levels being support resistance, this is really, you can't just draw a line and hope for the best. Price is allowed to go undercut it, go up, undercut it, go up. But then when it picks a trend, that's when you really know, it's picked a trend at this point, and now it's really going to the races, right?
I would say this is one of those situations where, you might ask that same question to Bill, and not that it would be a blow off, but he might even just give you the answer. It's one of those spots where he used to say it all the time, they'll either wear you out or scare you out, right? And so that's like one of those things where they're just wearing you out to see, who has the patience to sit, now whether you're, so anyway, that I would tell you is, they'll wear you out or scare you out. I heard come out of his mouth a whole bunch of times. So that is definitely one of those spots where they test your patience to see if they can wear you out before it gets going.
And moving on to another key point in terms of support and resistance, we've got moving averages. So support and resistance doesn't have to be static. It can also move with the stock's price. And we often see that with key moving averages. And we'll get into the specific ones that at TraderLine we use in just a bit. But anyway, we've got Roku here, another example from 2020. We've got the breakout buy point. And then this trend up is basically a nice steady trend. And you can see it's contained by the 10-week simple moving average, which is often a institutional support line. And once again, this is just an area of interest. It's not a hard and fast rule. We can undercut and reclaim it, but often on a closing basis, we'll stay above that key moving average if it's a potential true market leader, a potential model book stock. So like the static areas, static horizontal levels, this is just an area of interest where we could have support, but we don't know for sure until we confirm with a move off that key moving average, as we see here, and also right here as well.
When using moving averages as support, what's important is what we already covered in the prior slides, which is basically, is your M factor there, right? The M factor, basically what it represents is if a market is in an uptrend, a leadership stock should have some sort of respect for its moving averages. So what we're talking about here is Roku, which was basically a leadership stock in the 2020 uptrend. The fact that the price is being supported at the 10-week line when it retraces, so it breaks out, retraces back, and it seems to build a respect for this moving average, which is the 10-week line, which is considered institutional support while a stock is in an uptrend. So we see that same sort of behavior where stocks run up, tightens up, comes back in, and then is supported again, right? Stock runs up, and then we sort of what this is confirming is, given that the market is in an uptrend, given that the 10-week, it's holding its 10-week line, and it's considered a leadership stock. It's a point of interest for us to see. So at any point when we see Roku, say, for example, break the 10-week line and sort of close below it while the market is in an uptrend, right? While your M factor is in an uptrend, that might spell trouble later on. So that might add to your interpretation. So the fact that moving averages can be undercut, that's perfectly fine. They can be reclaimed, which is a positive sign. So you have to, again, use it within the context of what's going on in an overall uptrend. Price is allowed to undercut it like we did over here. But what really, again, we emphasize is the close is important. The close shows us the institutional thought process of what a stock is trying to do, especially given that this was a fairly liquid leader. It added to conviction given the fact that it kept holding this 10-week line, which is considered institutional support in a uptrending market.
And I'll just add what we'll talk about, Ray, if you could go back for just a second. We'll talk about breaking key moving averages later, but this is the first really significant close below that 10-week, which had been support. And as of this moment, Roku is still basing, still setting up, but this really marked the end of this very strong uptrend.
Moving on to base stages, counting base stages and why that's important. So each stock has, I guess, a birth and a death, I guess you could say. Let's take the ideal example where we've got a hot IPO. It's got fantastic earnings, institutional sponsorship, the whole 9 yards, and we get a fairly quick IPO base that forms and breaks out on huge volume. So IPO base is about as early of a stage one or as early as a base as you can have. So that's it's the IPO day isn't the birth of that stock according to the way we look at things at TraderLion, which is largely according to the Cancelin methodology, that it's born on the day that it actually breaks out or, even goes through an early pivot up the right side of that base. Okay. Now, through historical studies, done at William O'Neill and Company, we now know that the average move between one base and the next is about 20 to 25%. We also know that a stock goes on average through about 3, maybe 4 base stages before things get a little bit out of control and it needs to take a breather. It's become obvious to the crowd, and real companies will consolidate. And assuming that the story, their earnings, their product, their service all stays together, the stock may continue to trend for years and years and years, like a Cisco and Apple or a Tesla, just to, from older to newer. And so that's why this is very important. When we're looking at a stock, we want to know, for starters, buying out of a stage 1 and stage 2 base has a much higher probability of success than buying out of a later stage 3 or stage 4. The stages or the odds of a breakout failure or a failure occurring from a stage 3 or stage 4 base go up significantly. So once we're up at a stage 3 base and the stocks come quite a ways, that's when we start to manage risk a little bit differently in terms of adding sell stops, how we might take profits, and how it's always going to change along the way. Additionally, so we want to be very aware of what stage each of our stocks in and that we might be holding. And it's not always the case, but usually the case that you're going to have other stocks in the same group moving along with it. You want to keep an eye on the group as well. Let's say you just happen to be looking at a newer, younger stock that, let's say, happened to IPO 3 months ago, but the group has been fairly well developed. Let's say it's a newer, let's go use 2020 as an example. After the software stocks had come a long ways, already started to show signs of topping and getting tired, anything, even no matter how legitimate and how fast it's growing, its earnings will be. It doesn't matter if you've got one stock that's early stage, if you've got the rest of every other stock that's already up in a 3rd and 4th stage and showing signs of being tired. That's where that whole industry group and sector become very important. If the entire group is heavy, more than likely, no matter how great or strong that company would otherwise likely be, it's going to get dragged down with the rest of the market that has already gone through most of that life cycle, I guess, from the birth of its first breakout to wherever it starts to break down and fail in stage 3, and it could be stage 5 or 6. But once we start getting into stage 3 or 4, that's the time we start to become aware that we're getting up where that near that area that things don't start to work as smoothly. And we want to not only be aware of what's going on with that stock, but all of the stocks in its same industry group along with it. Just again, back to that sector and industry group thing, that's always going to be very important. That works. Yeah. And I'll be quiet after this, and I would ask Richard or Ray to kick in. Let's say you're looking at a stock that's in a stage 3 base and it's at that questionable area, but you're in a group that still looks like it has the potential to keep going, and that stock is one of the outstanding top 2 tier in the group. I might give something breaking out of a stage 3 base with everything looking fantastic, and the rest of the group, let's say, being closer to the top of its life cycle, closer to the early stages, I might give something like that a little bit more room.
And I'll just jump in here because we talked about the base count, but it's also important to talk about how that overall count resets. So the base stage basically resets when we have an undercut of the prior base, and that basically wipes out all the weaker holders and can reset the stock's run. It will base, reset again, and that is now a stage 1 base, and we can have another strong uptrend. And moving on to another very important concept, which kind of also gets into the life cycle of a stock, as Ross put it. Let's talk about stock phases. And this is all based on the methodology of Stan Weinstein. Go ahead and read his book if you want really more in-depth details about stage analysis. But we've kind of renamed it stock phases because it's just easier to differentiate between stages when it comes to base counting and phases like this. But anyway, the Weinstein base stages, they basically oscillate between stage 1, which is neglect basing, stage 2, which is a strong uptrend, stage 3, which is after a strong uptrend, once again, a kind of basing stage, neglect stage. And that stage 3 can either continue on with a strong stage 2, or it can transition from a stage 4, which is distribution. And from that point on, we can restart the whole process, go to a stage 1, or form basically another stage 3 and continue on with the stage 4. But anyway, how we kind of differentiate between the different stages or phases is using the 30-week moving average. That's what Stan Weinstein used. And you can also on a daily use a 200-day or 150-day, whatever suits your preference. But anyway, during the stage 1, we're going to be oscillating back and forth above and below that key moving average. Then in a stage 2, we're going to be decidedly trending above that key moving average. And you can see we might have some respect for that moving average during that. And during the strong uptrend, which is really when we want to be involved with any stock, we'll have bases form, then we'll break out, we'll move up, more bases along the way. And then finally, the stock gets a little bit long in the tooth. It's come a long way, and we'll have a longer term basing period, which could be a stage 3, where we're once again oscillating back and forth above that key moving average, the 30-week MA, and that line is kind of flattening. Now, as I said, this can continue on with the stage 2, meaning we can once again break out, and if this holds and the stock once again begins to trend above that key moving average, once again, we can start at stage 2. However, if we fail that breakout and the stock starts trending below that key moving average and the key moving average starts to slope down, as we see right here, that is the beginning of a stage 4 decline where we do not want to be involved in the stock. This is when institutions are distributing stock, and we want to move on to other opportunities, or likely the market itself is in a pretty bad state of correction or bear market, and we want to be in cash and on the sidelines and waiting for that next basing process, the next stage 1 transitioning into a stage 2. So just a brief summary, we want to be involved when the stage 1 first transitions into a stage 2, or during bases along this stage 2 uptrend. And here we have a real life example. This is NVIDIA, and right here we have a stage 3 after a strong uptrend. Then we can see this line basically marks the transition between this phase 3 or stage 3 to a phase 4, where we start trending below a declining 30-week moving average. That's this red line here. And then we start a phase 1 where we've got basing happening. And then at this point, we once again start a strong stage 2 uptrend. We have bases form right here. It undercuts and reclaims that key moving average. And we continue on with a strong uptrend until once again, a little bit of stage 3 action, phase 3 action here, but looks like right now we're continuing on with a strong phase 2 or stage 2. So that's kind of a recent example, NVIDIA. And you can see in real time that it's not an exact science. It's just kind of a framework, but really the big money is made in that phase 2 when we're trending above this longer term key moving average.
So what we've covered so far is really the basics, though it may seem bits and pieces of everything, combined together. What the first part of the presentation or the first 16 slides have been about is to really get you to picture, hone in on the basics. You need to know what, supply demand is, why close is important, why price, the relationship of price and volume, how to interpret that on a day-to-day basis, where a stock is in its life cycle of, is it stage 1, breaking out of a stage 1 base, that increases the probabilities a little bit. Whereas if you're buying a stock in a stage 3 or a stage 4 base from a stage 4 base, which are a little bit more failure prone in nature. So try to piece all of this together. This is really the foundation of what we're going to be we'll be leveraging all these concepts throughout the next sections as we go through the webinar. So if you want to pause here, that's fine. Sort of really internalize some of these, maybe even rewash the first part. So this slide basically covers it's a summary of what we've covered so far. So 75% of the volume is institutions in the market. A stock moves based on its what the trend of the market is, which is our M in CanSlim. The stock also moves based on 37% of its move is based on which industry it's trading in, and then 12% on which sector. So we want to be in the right groups. And then the CanSlim methodology really allows us to hone in or narrow our field of vision to those particular stocks. The next thing that we discussed is, the close being important, and the close being important. We want to see how the bar closes on a daily time frame and the weekly time frame. The weekly is a little bit more important once the market direction is in a correction. So the close is important. If you take away anything from the price and volume basics section that we have, is that make sure you're looking at the closing ranges relative to what the market is doing. We also covered what horizontal support is, what it represents, how stocks respect key moving averages, and how that could serve as support, especially on a liquid leadership stock. And then where is that stock in question with respect to its cycle? Is it a base 1, base 2? And then from a Weinstein point of view, which phase is it in? Is it in an accumulation phase? Is it running up the right side for a stage 2? Is it in a distribution phase, which would be your stage 3? Is it above the 30-week moving average, or is it below a downtrending 30-week moving average? So this is really the basic foundation of what you really need to internalize and sort of give, pause here, make notes, watch the first section again, because this is sort of going to be the launching pad of what we talk about the rest of the webinar.
All right, so moving into the meat of the course, we'll first start with identifying accumulation using price and volume analysis. And we'll discuss two main concepts, subtle and visible accumulation. And Ross, I'll hand this over to you. And I think we're starting with pocket pivots on the next slide.
Okay, sounds good. So what we're looking at here, let's first discuss exactly what is a pocket pivot. A pocket pivot, as we're looking at right here, is anytime the volume picks up bigger than all of the down volume going back 10 days. So this is the perfect example right here. I won't count them individually, but this is exactly 10 days from this bar to this bar. And as you can see, this volume is clearly bigger than all of the down days of volume in the prior 10. So that's letting you know that within this space, there is some, significant accumulation going on that you might not otherwise spot. So we'd like to pay close attention to pocket pivots, especially within bases, as stocks are consolidating.
And Ross, I'll jump in just quickly because I think it's important to point out that
please,
just because in this case, the volume is higher than the moving average, that doesn't have to be the case. This could definitely be below the moving average, which would be usually a 50-day or 20-day. But all that matters is that volume on that day was higher than any down volume in the past 10 days. This is a different way of determining above average versus using the moving average as a reference. So I thought I'd point that out.
No, absolutely, very important. I absolutely should have gotten to that. That is when it becomes, I guess, the most useful, because it's very easy to spot big volume bars that are clearly above average. However, you'll often see volume show up, like Richard just pointed out, that's below average volume, but still counts as a solid pocket pivot. And when you start to see those showing up along the way, that's much more significant, because you would otherwise, you're otherwise very likely not to see that unless you're specifically looking for that action. And as you can see, just a few bars later, significant volume comes in, pushes the stock through prior highs, and we've got the ensuing uptrend, which is exactly what we're looking for. This is your textbook breakout out of nice tight flat base on big volume and solid move upwards before you build another base here. This one's looking very cup and handle-esque, and at the bottom of this base, on these two up days, as we're starting to move back up the right side, we can see our pocket pivots come back in here and here. In this particular case, yes, we're well above average, but what we're looking at here is that in the prior 10 days, that both of these bars are bigger than any of the down days volume in the prior 10. So again, not surprising to see volume taper off as the base tightens up and moves sideways again, and then you see that big volume come in as it pushes out to new highs. Once again on a powerful uptrend before base builds again. And the idea here is it's, you know, these are two clues, not as subtle as they could be, because obviously it would be more subtle if we had below average volume. But the point being is it's letting you know that there's significant buying going on, worth paying attention to it at these levels. So here we are checking out an example of volume signatures on an RH chart as it built its larger basing structure here, and taking a look at some of the ways that we can look at pocket pivots and pocket pivot volume signatures to point out areas of subtle accumulation as within the structure of a larger base as it's forming. So starting right down here, we've got a 5-day pocket pivot. The only way that this is different than a regular pocket pivot is that rather than being the volume being larger than any of the down days in the prior 5 or in the prior 10 days, in this case, it's in the prior 5. They're more significant when they show up in clusters. I would even tell you that seeing a couple of 5-day pocket pivots, 2 or 3 of those are, I'd almost rather see that than, you know, your one big pocket pivot. But regardless, they're both worth paying attention to, and a really great way for spotting accumulation, especially this early on within base building structure. And you can see as we move along here, for a pocket pivot to be officially a pocket pivot, it's got to occur within a base. So once we start moving out towards highs and breaking out here, you'll see we've got pocket pivot volume signatures. In these particular cases, these 2 days of up volume are larger than any of the prior down days volume in the 10 days prior. The only reason they're not officially pocket pivots and referred to as pocket pivot volume signatures, which is still letting you know there's a subtle but significant accumulation going on there, is because of where the actual price action is in this overall base structure. However, you know, if you want to look at it on a much bigger picture, looking at this as your breakout, you could certainly call those pocket pivots along the way in this larger structure, using this as your textbook breakout.
So just to summarize, a pocket pivot volume signature occurs when a volume is higher than any down volume of the past 10 days. But as we see here, it doesn't have to be above any particular moving average of that volume. Here we have a pretty low volume relative to the moving average, but it still is a pocket pivot because it is above all that down volume. And this has to occur within a basing pattern, which occurs right here within this overall longer term base. And once a stock breaks out, this doesn't actually count as a pocket pivot simply because it's breakout volume. It's a little bit more obvious. It's not subtle accumulation, which is what we're focused on here.
So here we are, we're looking at another form of subtle accumulation. In this particular example, it's tight action. You'll see a tight area is simply an area where a stock is moving sideways. In particular, where we've got, it's harder to see here, tight closes, but the fact, and you can see we're all more or less in line across the board here. We do get a slight dip lower here, but in general, this is a relatively tight area. And the thing to pay attention to here that is important to understand is this volume dry up. So that's letting you know after this big volume push higher, volume tapers off as the stock moves sideways here. That's letting you know there's not really a whole. So this we would see it as an institutional accumulation, this big volume push up the right side, and the fact that all of a sudden, you know, there's nobody willing to sell stock down here is letting you know that that's stock likely being accumulated, not always, but very likely. And lo and behold, the big volume shows up again as the stock breaks out to new highs, and we get a solid trend higher again, indicating that that was very well, accumulation going on in this area as the stock moves sideways and volume dried up. Now we're moving on to the next chart is tight action. However, we've got heavy volume here, which is the clue that something's not quite right. When you see tight action and it is not accompanied by a big dry up in volume, that's letting you know that is not necessarily accumulation, especially when it's coming after a solid move higher. Also, it's where you want to pay close attention to the actual closes, the actual price volume action going on here. So you can see here, this ultimately, even though this is a blue bar, this is all 3 up days. You can see they all closed not so hot, low. Thank you for pointing that out. These 3 days here, even though they're up, had weak closes and volume picked up, those are stalling or churning days. Even though the closes are ultimately tight, that's letting you know that institutions are probably unloading some stock there. We've got a few days, and I guess you could say we get a quiet day here. Volume tapers off. It holds relatively tight still. And then ultimately the stock starts to break down as volume picks up along the decline. So again, that's why it's very important to pay close attention not only to the volume that accompanies a tight area, but the actual action that's going on within that area, especially on the days where you might want to glance at an up day and assume that, hey, it's all as well. It's an up day, volume was big. No, in this particular case, these are all 3 of these days are considered subtle distribution.
So now that we've covered subtle accumulation, which is basically pocket pivot signatures within a base pattern, and tight areas that are constructive should have a dry up in volume. Next up is visible accumulation, and one of the first ones that we covered in the course is the step up in daily average volume. So the concept here is as a stock is going through its phases and trending or gets in the eyes of the market a little bit more than it has been, what we've noticed is as new industries pop up. So if we talk about, anything to 2010 and beyond, we've seen software come up as a leadership group that it wasn't in the past. We've seen, and it seems to be that when new industries pop up and the new factors coming in and a stock is getting in the eyes of the market a lot more, is that we see a clear step up in volume as market participants that want to position in the stock are interested. They want to accumulate more shares. So one of the more visible ways to see this, and this is important from a industry point of view, if an industry is seeing volume across the board on all of its names, that shows you that institutions are stepping up. They see this as a theme in the market for maybe the next 5, 10, 15 years. So they begin accumulating stock. So one of the examples that we have here is Amazon back in 1998 started seeing that similar pattern where once a stock is public, the story is out there, institutions are doing their research, and when multiple market participants sort of gather and see potential in a stock, we start to see the fact that volume is starting to step up, and we see like a clear that there's a clear the moving average on an average basis. Amazon started trading more volume on an average basis. The volume is now about 30 million. Obviously these are split prices, but that's one of the signs that you want to watch for. Is there an industry out there that's up and coming, right? Given that we're in 2021, we had a smaller theme in the 3D space that popped up where a bunch of 3D names, 3D printing names started seeing such volume across all of its, all of the names in that industry group or social media, for example, recently with the newer names in Pinterest, Snapchat, Facebook, that sort of, that's a new industry that did not exist back in 1998, for example. They start seeing a step up in daily average volume. So the key takeaway from this is this sort of step up in daily average volume. Just another one to add is the genetic space, right? We've seen a recent interest from institutions to sort of position and stock in that space. So that sort of becomes a theme to watch for the next 5-10 years, as we're seeing, what we saw as institutions are interested, as they see potential or, multi-decade potential in stocks, we see this visible accumulation on the charts. Next up, on visible accumulation, the second thing that we look for on the charts that is really obvious is if a stock is gapping up on big volume and we see it put in, the volume on that particular day when it's gapping up is highest in over a year or the highest ever, right? So that is, big volume stick. There's a catalyst behind that move, and it puts in a high closing range. So what's important to us and why we keep emphasizing the fact that the close is important, especially when a stock gaps up and the volume is very high, we want to see institutions step up, show interest on that day, and put in a high closing range. That sort of shows us that there's conviction there. They've done their homework, and you want to see that on the charts. And that's the second characteristic of visible accumulation. Moving on, what you don't want to see on a chart based on, and we'll cover a real life example coming up on the next slide, is we want the closing range to be at least a minimum 50%. So our goal in the markets is to stick with the best of the best of the best stocks, and the best of the best stocks are not shy when they gap up on big volume and they have the catalyst. Institutions have done their homework. They will put in a high closing range, and there's very little reason for a stock to put a low closing range on that particular day, given that there are multiple participants that sort of see potential. That is the reason why we get a plus, a high closing range, whereas something that runs up in the morning or early in the session, but then the closing range is low. So we want to see a high closing range. Real life example of visible accumulation with big volume recently, back in 2020. So this is 2020. We're talking about Snapchat. Is we saw Snapchat gap up, and this was on a earnings report. So the stock gaps up on big volume and puts in a high closing range. And given the fact that, now we see that it puts in a high closing range on that day, it gaps up, and then we start seeing tighter action on these days where supply is sort of absorbed, which is what we covered in the price and volume basics section earlier in the webinar. That's exactly what you want to see. So the stock tightens up and then eventually goes on a run. So this is as obvious as it gets. There's a catalyst for this particular price gap up. The price holds that gap up and puts in a high closing range, and we're looking for greater than 50%. Next up, so what we've covered is after the big gap up in volume, the other visible accumulation, and I think this is really significant, is the highest daily volume since IPO. So if we really think about it, the example that I'm going to cover here is Pins. Pins on IPO day had about, just estimating, about 90 million shares in volume. And the fact that, it goes through multiple earning cycles, it gaps up here, but the closing range is less than 50%, and we see failure in the stock, right? This one gaps down. So we see a gap down in price with a high closing range. But given that, this is basically the market discounting whatever it is that happened. Could be a news catalyst, a earnings catalyst, The market does not like it. The stock stays in a downtrend. We see a similar story here. The stock gaps up, right? It's not able to hold its closing range for whatever reason, and then it enters a severe correction. So this is why we want to emphasize that the best of the best of the best stocks that are, from a visible accumulation point of view, close greater than that 50% closing range on the day that they're gapping up. The characteristic that we want to discuss on this particular slide is the highest daily volume since IPO. So what this really tells us is the fact that the volume is the highest ever in the life cycle of the stock says that there's new interest in the name. So something has happened that caused this price gap up. It could be a earnings catalyst, could be a news catalyst, could be something that the market as a whole likes about this. In this case, it's Pinterest. Basically there's new interest in the name. That's what's key about this particular characteristic. There's new volume that's coming. It put in a single day volume of 110 million. And then what's important is we see that the closing range is greater than 50%. And then also the general markets, which we covered, under the basics section, the market was also in an uptrend. Now we have visible accumulation, which is the highest daily volume since IPO. We have a high closing range of 94%. Now we're basically building a recipe for success that, this stock may do something like this in the coming weeks and in the coming months. And we also have the close greater than 50%. Again, once it gaps up, we see tighter action following its gap up in price. And then eventually as it consolidates, we see a run up. So that covers the visible accumulation. And the key here is the highest daily volume since IPO. There's new interest in the name. To summarize what we've covered in this section on how to identify accumulation is we went through, subtle accumulation, which is, could be on below average volume within a base, which is pocket pivots. That's something you want to look for as a stock is base building. The second thing that we covered is tight areas. We said constructive tight areas have a dry up in volume. Non-constructive tight areas have above average volume. So you want to look for the constructive tight areas. Step up in daily average volume. This is really a underestimated concept. You want to see industries that are seeing a step up in daily average volume, which will tell you the themes that are coming up, be it the genetic space, the 3D printing space, the social media space. If there is a surge of volume, that's institutions. Again, institutions make up 75% of the volume in the market, and they will show up, which is a form of visible accumulation. The other thing under visible accumulation was a big gap up in volume. Again, we want to see closing ranges higher than 50%. And then the last concept that we covered under the visible accumulation portion is when a stock sees the highest volume since its IPO day, that tells you there's a new interest in the name. This is volume that it's never seen before. Again, we stick to the stocks. There's no excuse. If the story is there, the market trend's there, the catalyst is there, there's no reason for the stock to put in a closing range that is less than 50%.
And Ray, I think if you go back just a second, I think there's a question that probably a lot of people are wondering, does the highest daily volume since the IPO have to align with a large gap up like that on earnings, or is it still significant even if there's no significant news catalyst like an earnings report?
I would say it has to be some sort of catalyst. Could be a new CEO, some sort of news information. There's something new about the stock that's happened that's causing that. Sometimes we do see that. I think there's an example in the course that we put for Facebook where it put in the highest volume since IPO, but there was really no catalyst to back that up. And then the stock ended up failing. So the catalyst portion is also important. If the market's paying up for a particular stock, and then after it pays up, it's holding that range on a closing basis, which is very important to say that, this is that there's something that's different about it. The market is in an uptrend, and it also is being accumulated during the session rather than just gapping up and fading, which is what we saw several times on pins before it really got going.
And moving on to developing conviction, we'll talk about relative strength in terms of days, phases, how we use key moving averages, what we look for in terms of key moving averages bunching up and forming a launch pad, and also using weekly charts to make sure we're really zooming out a little bit and looking at the big picture. So Ray, I'll hand this off to you, and I think we'll start with relative strength.
Right. So the point of this section is going to be to sort of, now that we know the characteristics that we're looking for tight areas, we're looking for pocket pivots, subtle accumulation, visible accumulation. How do you develop the conviction behind that to sort of enter the stock? And how do you separate a market leader, for example, from a stock that might show those sort of signs, but isn't really a market leader? And this next section will really help you with that, or was designed to help you with that. So first up is, how do you develop conviction? So in this particular slide, we're going to cover the concept of relative strength, what it means, why is it that we see this again and again and again in market leaders. So the example that we have here is, once again, Amazon. The market enters a downtrend or a correction. And once the market is in a downtrend, what you want to be keeping track of is which stocks are basically bucking the trend, which stocks are holding up relatively well versus what the market is doing on a day-to-day basis. And the way we visualize that is we put the RS line, which is basically a ratio of what the index is doing, which is the S&P 500, and what the stock is doing, and we divide the two numbers to get the relative strength line. Again, what I want to emphasize is the line itself is where the meat is. It's important to interpret the line properly. A lot of people get hung up on what the rating is, or what the number is, or why is this 10%? Just forget this for a second, and let's just focus on the relative strength line. So as the S&P 500 enters a downtrend or a correction, what we're seeing is, so one of the first things that we said is, why do we like greater than 50% closing ranges? Again, Amazon gaps up likely on earnings here. We see a closing range of less than 50%, right? It tries to rally up and out, but we hit a correction in the markets, which drags down price. Now, the fact that the S&P is in a downtrend, and on a relative basis, Amazon is trying to hang in there during a corrective phase, we see the RS line, which is this purple line over here, start rising. So we see the purple line that is rising as the S&P 500 continues into a downtrend. Now, this is as clear as it gets in terms of developing conviction. The only force in the market that can hold up a liquid leadership stock while the market enters into a correction is, again, 75% of the volume, which is the institutions in the market. So what the institutions are trying to tell you here is, we're accumulating stock. We want Amazon. We see value in Amazon on a long-term basis. Even though the market's in correction, it's being accumulated, and that accumulation shows up in the fact that this purple line, which is a relative strength line, is rising as the S&P enters that correction. So that's really the concept, is the stocks that hold up well while the market goes through its corrections and then uptrends and corrections. Is basically the ones that hold up really well during the corrections are ones that the institutions are accumulating. And that's how you basically develop conviction. So when a market is in correction and you're working on your buy list, Amazon would rank fairly high, given the fact that its relative strength when compared to the general markets as a whole, it's trying to outperform. So that covers the first concept on how you would go about developing conviction.
Just in terms of relative strength, I guess divergence, not only the relative strength divergence from, the market or the S&P 500. I mean, you can just see in general, according to the textbook, we want to see a relative strength line go into new highs as a stock breaks out pretty much at a bare minimum. So when you're seeing the market in correction and a relative strength line making new highs while, the stock is still trying to get itself sorted on the way down, and it's got this kind of vertical screaming thing going on as it just starts to, build. I mean, that's letting super early on that pay attention to this stock when it breaks out that relative. I mean, like we said, going all the way back to the beginning of whatever you call the beginning of our recordings here, that is, I don't know. Anyway, back up. I don't know the word. You're on mute, Rich. I don't know the word I'm looking for, but that's a big deal. That's to me that, once I see that relative strength line making new highs, even while the stock is still in correction, every moment I'm sitting in front of my screen, you can bet I'm drawing and redrawing that alert line as it builds the right side. As long as that relative strength line is still doing that, that is a clear sign that you've got a big winner on your hands. I have found, and that is one thing. There are so many different things, whether it be distribution, things that work better in certain market environments than others. This relative strength, new highs, when that line in and of itself, like Ray says, forget the value, forget the number, on a relative basis, when that's making highs while the market's weak, and especially when the stock itself is still correcting, that's letting you know to pay very close attention. Those stocks that have the relative strength lines like that are these big, liquid, powerful leaders with the huge earnings growth, are at the top of my lists always. And my alert lists, those are at the top. That's where all my focus is.
Okay, so the second concept under developing conviction is we get really granular. It's just a variant of what the relative strength line is doing on a day-to-day basis. So we did a study on the most recent correction that we had, which is the Feb 24 to April 6 correction in the markets. And what we found is, on a relative basis, stocks that went on that perform, 100%, 200%, 300% from such a severe correction in the markets. And it's important to not get caught up in the number. The number can be 50%. If it's a normal correction, given the severity of the correction, we had a really large rally across the markets, which caused some stocks to go up 150 to 200%. But the concept that we're trying to cover here is as we track RS while the market is in correction. So the market correction starts where this vertical red line is, and we started tracking the RS. As an example, we're using Zoom video. So it exhibited RS 19 days out of the 31 days that we were in correction in the markets. That's, on 61% of the time, ZM was trying to fight the market trend. And that's basically what the concept, the relative strength count is trying to cover is 61% of the time ZM was outperforming what the market trend, what the market was trying to do. And that's a positive sign. Again, that's how you develop conviction in a name. So as you track it while the market is in a correction, given the fact that 61% of the time it was outperforming, and then we start a new uptrend, ZM is off to the races. So it's important to keep track of such names, and sort of this adds to your conviction once again, given the fact that there was some sort of clear accumulation in this, given the fact that it was bucking the trend for 19 out of 31 days. So moving on, we'll cover what a relative strength phase is. Again, this is a variant of what the relative strength line is trying to do. So phases in a stock basically reset. This is basically another concept, is phases reset when market enters a correction. When a stock starts a new relative strength phase while a market is in correction, that means the RS line is moving to new high ground while the market is in correction. that's exactly what you want to see. And in this case, SE, for example, exhibited the same thing that Amazon did, the same thing that Docu did, the same thing that Zoom Video did in the March 2020 correction. Is the RS line made new high ground or entered a RS phase while the market was in correction. And that's really, if there is a holy grail type of setup, this would really be it, given the fact that this stock is trying to resist market pressure. And this is just another way of looking at it, that the RS line is now at new high ground. And then it just so happens that the market is cooperative and it goes on to rally some crazy number like 250% in a matter of several months. Next up, we have, now that we've developed conviction through the means of relative strength. So while the market is in a correction, we look for stocks that are trying to buck the market trend, which is this blue line here. The RS line is rising. So how do we once we develop our conviction in this particular zone, how do we keep ourselves in a trend? And that's basically what Ross is going to go over now.
Okay, thank you, Ray. So exactly, now that we've got our, as you said, conviction developed, we're seeing the accumulation, might even you can start working your way in a little bit early before we get to its ultimate high here. And like so many other big high quality leaders and what I would consider a model book stock, these are the ones that tend to attract the big high quality institutions. Along with that comes with institutional support at logical areas when these stocks are in correction mode, and hence why you'll start to see, not all stocks respect the same moving averages, but ultimately after they break out and as they make progress along the way, consolidating, you will see many of these higher quality liquid institutional names give respect to particular moving averages. And in this case, we are looking at an example of LVGO from, I guess, is this back in 2020. So after this breakout, it acts like a champ. What we're looking at here before we get going on, let me back up a minute here. Our red moving average, our longest term, is a 200-day simple moving average. The black, thank you. Our black moving average and orange or rust-colored moving average is our 50-day simple moving average, and followed by this rust here in orange is our 65-day exponential. Our shorter term moving averages, it might be easier to just point to over here. The one in cyan is our 21-day simple moving average. Our purple moving average just above is the 23-day exponential, and our shortest term is going to be down here, our 10-day simple moving average in green. So after the stock breaks out, we can see we get a little bit extended, stock pulls back, volume dries up exactly as we want to see it, as the stock's drifting into its moving averages right here. And you can see we pick up support at its 23-day moving average. That's only its first pullback, but you can see it successfully holds, picks up volume, breaks out again. So on its next consolidation that we're looking at here, we can see again we get a much sharper pullback and drop below this key moving average, the 23-day again. But as you can see, and again, Ray pointed out a few sections back, we do our best to look at everything on a closing basis. So in this particular case, assuming you have bought correctly up until this point, you should be able to ultimately sit through a day like this and give it to the end of the day, because typical bull market or positive action, you're a lot of times you'll see the rebound towards the end of the day. So if you don't give your stocks until the end of the session to prove themselves, you're in a strong bull market, you're definitely taking advantage away from yourself, as hard as it may be to sit and watch that happen. Again, you don't want to let a profit turn into a loss watching that happen. You don't want to put your account in danger. This is the kind of thing, provided that you've, possibly bought early back in here, topped off a position here. Maybe you added a little bit here, so a pullback here, maybe it makes you sell some, but you should not be losing an entire position. And as you can see, on a closing basis, you snap back and close right back above, which is telling you that the big boys out there were not a chance. They were letting it hang in the gap by the closing bell. You can see the stock almost closed positive on the day. So that's that's subtle accumulation, I guess you could say, just because it's a pink day. That is actually a very strong day of accumulation, especially the way it reclaims its moving averages there. The stock goes on to consolidate a little bit more, acting super constructively. It tightens up, continues to show respect for its 23 exponential moving average in here, breaks out again on big volume. And you can see here the stock tightens up and consolidates. And in this particular case, it holds what it's looking like it's a 10-day moving average in here before it just, goes on more or less, the angle up continues here from what we've seen. Now we're, I guess, stage one, stage two-ish. We're getting a little bit late in the move. And as you can see, throughout the length of the move, we're holding this 23-day moving average. The first time we actually break, you can see, is right here. However, we are picked up by the stock's 50-day moving average as we tighten
Right
up
here,
on-
you're talking about right here?
I'm going to clear out a lot of this mess that I've made. So you can see there's our first violation of the 23-day moving average, even though volume it picks up a little bit. It doesn't go to way above average, but it does pick up relative to what it does. Fortunately, the stock remains, continues to consolidate tightly, constructively, hold its 50-day moving average and work its way back up to its prior highs for a potential new breakout. But you can see, and I might have gotten a little long in the tooth on that one. This one made it extremely easy. I consider myself lucky if I can buy a stock as it breaks out, or even early anywhere in here, and even add once or twice, along the way, and be held in by its 23 exponential moving average, and only be forced out of maybe say a little bit here. Oftentimes what I'll do is, and it depends, in this case, maybe not. The 23-day exponential was very close to its 50. So there's not a whole lot of value or benefit in taking profits on half your position on a break of the 23, because of the 50 is right there. However, I would pay close attention to where all of your, moving averages are bunching up here. If it were to break the 50, I would certainly think about selling some and watching how it acts at its 65-day exponential. And if it were to break through there, I'd happily let go of the rest of it and buy it back higher if need be, because that's heck of a move there from, it's very tiny here, but I guess roughly $30 to what is it, can help the old man's eyes, 150. Okay, so that's a huge move in a short period of time.
And I'll just add, right here within the base, we've got all the key moving averages that we'd like to focus on bunching up below the price, which we've seen can act as a kind of launching pad that can produce a move like this if the market is extremely cooperative. So this is a key characteristic to look for. All those moving averages consolidating together, very close within the same kind of price range, and then that shifting to the support, and then the stock moving up off those key moving averages.
Bad miss by me there, Richard. That should actually be marked. And that is another thing I love to see, especially, backing up a little, stock, as a market is bottoming, trying to reestablish, the big leaders. That's another thing that I'm looking for, along with the stocks that are screaming relative strength. I love to see groups of stocks starting to build the right side of their bases together. And very often you'll see, if you pay attention to whatever the lists I put out there, the top 10 report, you'll see that's something that I will always point out when I catch it. And you'll start to notice, you'll start to see that particular launching pad where all of those moving averages converge in a tight bunch beneath the price. And again, I'm starting to see that more and more now as I've created the last, and that's another important, that helps develop. When I see that along with the relative strength, that helps me develop further conviction, right? Because that's telling you that the institutions are stepping up, not letting it below that, where all of those moving averages are, and it's time to pay attention. So that it also lets you know that you may, when you start to see groups of stocks behaving that way together, it lets you know that there's rotation, right? Moving potentially into that group. You might be looking at a new theme, a new, area of leadership to the market. It's time to pay attention when you start to see all those, the high relative strength, high quality stocks, when you're starting to see them all come up the right side and the moving averages converge together, like we're actually starting to see now on more of your classic growth stocks, and not so much those, industrial names we've seen working with the Dow and the S&P over the last few months.
So just to add to what Richard and Ross said, one of the other things that we're seeing is the step up in daily average volume. This again shows us institutional interest. So this is really now a recipe, right? The point of this course is leadership blueprints. What are the blueprints that a stock is showing before it makes such a large run up, right? We're sort of going sideways or away from moving averages for a bit, but this one had, you had your RS while the market was in a downtrend. We had the KMA bunch up right at the sweet spot, which we call the launch pad, and then the price starts to move higher. We see a step up in daily average volume, which again, these are all blueprints or hallmarks of what a leadership stock what leadership stocks do on a consistent basis before their run-ups. And that's really what you want to watch for. One of the last things is, effectively using moving averages. One of the things that Ross has taught me is if you were to position somewhere in this area, be it 3019, 3182, as soon as you're, for example, if you're, depending on what your goal is in the markets, if the 50-day moving average basically starts curling up above your average price, that could be one way or a way to effectively use the 50 DMA to sort of manage your position, which would eventually at some point kick you out. In this area, if you're looking to get out of the stock, or what we go for is 2 closes below a key moving average, right? So the fact that, LVGO was one of the leadership stocks in the 2020 uptrend, it respected its 21 DMA and the 23 EMA, which sort of rode up all the way. And then the 50 DMA, if you're really, depending on your goal in the market, if you use the 50 DMA, it really never kicks you out. But all of it started, again, the fact that it had RS in that market, the KMAs were bunching up at this point, and it really served as a launching pad. There's a step up in daily average volume. And then now what we're covering is how do you manage it once you sort of get into that position?
We just covered, again, respect for moving averages fairly well in the last example, but here's another example, again, like we used earlier, ZM. We get the relative strength exploding, letting us know that the stock was rearing to go. And you can see here as the stock breaks out and starts to make progress, we get a clear respect for its black line, which is its 50-day simple moving average here. The stock breaks out again, and you can see it continues to respect its 50-day until this point. We get 2 closes below. But as in many cases, the stock 65-day exponential moving average will pick up and become support for where the 50-day failed. So in this case, depending on where I owned it, I might sell a portion of stock on the break of the 50-day, hang on to the rest using its 65, and had it broken in this case, I'd be out of the rest of the stock looking to buy it back at a more viable point in terms of risk reward. As we can see, the stock makes a big move all the way up to 400, but ultimately, using the 65-day as your key moving average in this case, we finally gap down, break below on huge volume, and ultimately the stock enters a downtrend from here. So that is really it. Once again, as you'll hear Ray and myself so many times say, you want to see your trade end on a bad note, and that is why using a key moving average that a stock has shown respect for throughout the length of its move. Very often when it breaks that average on big volume after a big move, it's time to walk away.
So just to drive the point home, here's like a zoomed in view on a other stock that was showing RS again, We see RS while the market is in a correction, the relative strength line, which is the blue line, rises. We see the stock trying to buck the trend. And what we see here again is that what we call a launch pad, where all the KMAs that we use on a net basis sort of bunch up, and that tells you that on a net 10-day basis, 21-day basis, 23-day basis, 50-day basis, and a 200-day basis is that, you know, the average closing price on all those frames sort of lines up, which serves as a launching pad for something like a coup, given that it was also showing RS in a market correction.
All right, so what we're looking at here is a weekly chart of PayPal, and what we are looking at here is very simple. It's weeks of accumulation versus weeks of distribution. It's something that Bill went over with us many times while I was there as PM, and it was just a very simple, quantifiable way to you know, give you a big picture thumbs up or thumbs down as far as a stock's particular base. So keeping that in mind, let's take a look at our first base here. We see marked 2 weeks of distribution versus 3 weeks of accumulation. How that is counted is this. Here you can see is our prior uptrend. Here is the top of that uptrend, and our, thank you, first week down starting here. So that is where this, you know, you always start counting the first week of a base as its first week down. So here's our first week down, and we can see on this week here, we've got a massive week of distribution. I'm going to remark it with the blue arrow that goes with this gap down and close, but below major moving averages. That is followed up by, however, accumulation. Or a week of accumulation. We can see the stock holds its weekly low from the week before, reclaims its 50-day, or I'm sorry, let me get that right, reclaims what looks like, I'm going to tell you this red line is its 200-day simple moving average, but it gets stuck at its shorter term 50-day moving average, which is this black line here. So you can see we're closing below both moving averages here, but we get a week of accumulation where we reclaim the 50-day or the 200-day, but get still stuck below the stock shorter term 50-day moving average. Now, as we go on to this next week of accumulation, and you'll see this is, even though it's a pink week so far, this is our biggest volume. It's marked by this big black arrow, even though we shake out well below the lows of many weeks prior, you'll notice that we close back up very close to the top of the range, almost positive. And once again, we by the end of this week, we're closing back above the stock's longer term 200-day simple moving average. So you can see even amongst all of this, you know, turmoil across here, as volume really picks up these 3 weeks, there's subtle accumulation going on if you're paying close attention. Ultimately, our biggest volume comes on this down week here. This is straight up distribution. There's no ifs, ands, or buts there. The stock gaps down below its 50 and 200-day moving average and just falls apart, closes on its lows on the biggest volume you've seen in quite some time. However, as the stock ultimately puts in its bottom and works its way back up the right side of its base and breaks out, we pick up another big week of accumulation here at the very bottom of its base. And you can see this is considered constructive action. This red week we'll see is a much tighter range. It holds within the range of the week prior, and volume declines to well below average. And on the way back out again, we'll see we've got volume picking up from the week prior here and here as it moves its way back out. Here I have, again, marked 2 weeks of distribution versus 3 weeks of accumulation. But if you go through closely and look at all of the potential subtle weeks, even as the stock bottoms and works its way higher, you can see that there's, you know, on balance, there's clearly more accumulation going on here relative to distribution. So after we've got this breakout comes on that big volume here, nice trend higher, and a new base forms, or base number 2, where we've got marked 2 weeks versus 2 weeks, accumulation versus distribution, which ultimately doesn't work, at least from as far as we've got this chart marked here. But let's just go take a quick look here. We've got a solid move higher. Here's where the stock ultimately tops out, but it's also our first week down. So that's where the beginning of our new base begins. We get so you can see in 1 week, we're going from all-time highs and pulling all the way back to a stock's 50-day moving average, just barely closing above. That's a clear week of distribution. You can see that's our first week marked here on above average volume. As we go along, this is negligible, if anything, could be seen as neutral to positive. It's an inside week. That one comes on less volume, followed up by another week of just distribution where we sell off on heavier volume than the week before. Here we encounter our first week of accumulation. And how are we doing this, by the way? Basically, we're going to look at I want to look at every within the base, every pink and blue line that's coming on above average volume. We want to analyze whether it's really accumulation or distribution and tally one versus the other to see on balance what we're looking at. So I just wanted to go back and give you, forest for the trees as we're digging into the last few days here.
And Ross, just to clarify for people who may be confused, is it the closing range you're looking at to determine whether it was a accumulation versus distribution?
If you remember going back to, a little bit earlier when we were discussing analyzing price and volume and the close. So yes, you're exactly correct. We're looking at the closing range versus volume, right? We're looking at all the weeks on above average volume and whether those were accumulation or distribution. And then we want to ultimately tally accumulation versus distribution in that base on a weekly basis. And that just, again, gives us another clear-cut, quantifiable way to help assess, a stock technically. Are we looking at more buying versus more selling? It's great to know on an individual basis, and it's something you can keep track of. As I'm a fan of always doing in the leading groups. I always want to know, is this just with one stock, or is this something that I'm seeing in the top 2, 3, 5 relative strength, high quality stocks in that stock's particular group? Are we starting to see more distribution? Might that lead to rotation from here to over there in stocks that are, earlier stage, showing more accumulation in their bases, so on and so forth. So that's it, being said here. Which week did we end on? I think this
this one right here, I believe.
Right. So that is our first week of accumulation. So here's our tally: 2 weeks of distribution, 1 week of accumulation. These 2 weeks are ignorable. They're on below average volume. Here's our next week on above average volume right here, which is a week of accumulation followed by another week of distribution, which, ultimately, for this chart was its swing high. At this point, you get a reversal on big volume. And so at this point, you've got an even count. Overall action is probably a little more negative than positive. So at this point, it's not necessarily that you want to kick it off your list, but it's at least telling you that it needs a little more time moving sideways before you.
So Ross, the week that it made a high through that 212.45, that's basically a base breakout, right? And before
yep, that's a breakout failure.
And then at that point, what we basically have is we have 2 weeks of clear accumulation within the base, and then we have 2 weeks of distribution within the base. So how would you go about analyzing as it's breaking out of that base? Would it be a neutral stance?
I think, so let's go back and see what stage base are we in, right? So maybe if this is a stage 2 base, is this stage 2, stage 3, right? and I'm trying to see if we can get an idea here. The
This
prices
will
are
likely be a stage 2 after it undercuts the prior base from
Right.
124 to 82 back in March 2020.
So I would
and
say-
it rallies up.
right. I would say in a stage 2 base, this would be more of a neutral to me. I'm not seeing anything here action wise that would tell me that this is flawed or broken. So as long as it continued to act well and build a constructive base, and the other stocks that are its peers were also doing the same, that I would pay attention to. So yeah, there's no that you're not getting a clear cut kick it off your list. Yeah, this is a keep it on your list and continue to watch for constructive action is what it's telling you.
So what if it was 3 weeks of accumulation within the base that it was in, and 1 week of distribution? That would basically, from a weekly chart point of view, that would be a big positive for you, right?
Absolutely. Yep. I mean, sure. I'm always, I guess you could do it, like they're counting cards, with the plus, either adding one or taking one away. It would be that thing, just the tally count. I'm always happy to see, 2 or 3 weeks of accumulation extra. That puts a smile on my face.
Absolutely. And actually, before we continue, just to clarify for people, we're talking 200-day and 50-day, but obviously it's a weekly chart. So that translates over to the 40-week and the 10-week.
Thank you. That's important to clear up.
All right. So now that we've covered how to basically identify accumulation within the stocks, and also kind of increased our conviction through relative strength techniques, now we're going to move on to kind of the other side of the equation, identifying distribution within the market as well as individual companies. So we'll cover distribution days, breaking key moving averages, climax tops, late stage bases, and also improper charts. So Ross, I'll hand it over to you. And I think we're going to be talking about distribution days to kick things off.
So in this slide, we are going to talk about distribution. What distribution is simply when either the NASDAQ or the S&P 500 closes down at least 0.20% on more volume than the prior day. Volume doesn't have to be above average. It just needs to be down more than the prior session. There's a few ways distribution can show up. The easiest one to spot is our clear red distribution day. That's when we've got our sell-off of 0.20% or more. Volume picks up from the prior session. It meets the most simple definition, very easy to see. Our subtle distribution or churning day, which can also be referred to as stalling. Stalling and churning are synonyms. It doesn't have to be a blue day. It can be pink, but the whole point here is that you're seeing us in this particular case, the index was trading at new highs, but not only the highs of the day, but at new highs, even relative to many days or weeks prior, depending on what you're looking at here. But by the close, it fails, reverses, closes near its lows, and volume picks up significantly from the prior day, no less, going back quite a few days. So that sort of failure on volume, even just because you've got the blue color and it was an up week on big volume, that's why we call this subtle distribution. That's actually, an ugly distribution day when you get a failure from highs that closes on lows and volume picks up tremendously there. So lastly, we're looking at a red accumulation day or pink rally day, as you may have heard it referred to before. It's very simply just the opposite of your churning or stalling day, where one of the indexes that was trading at lows of a session down from the day before, below the lows of the prior day, ultimately in reverses, closes near its highs for the day, and volume picks up in a major way. Just because the day is red or pink in this case doesn't mean it's necessarily negative. That is a clear day of accumulation. So these are understanding how to properly analyze and understand whether price volume is denoting accumulation or distribution is it's very important. You can't just glance at what color it is and the size of the volume and assume you've got the whole picture in mind.
And just to add to what Ross is saying is, again, the closing range is important. So the closing range on this particular bar is basically at the lows of the day, which is going to be 0%. The closing range here may be On a smaller frame, it was trading at this point, but on a on a closing basis, this would clearly be less than 50%, which is why we emphasize the close once again, and then the closing range, which is relative to the low on this case, was fairly high. Though the bar looks red or pink on your chart, it really, the market sort of rallied up and finished higher up in the range, which in this case again was greater than 50%, which is why we keep emphasizing that the close is important, and it sort of determines what type of day it was. Was it a clear red distribution day? Was it where we attempted to rally but then closed down on the session, or where we made a trip lower but then closed back up on the session? So that sort of the close determines the type of day that it was in the market.
All right, so in this example, we're looking at the NASDAQ, and we're just going to take a quick look at a couple of real live examples of distribution on an actual chart, not too long ago. This is the 2020 decline and rally thereafter. So this is distribution just prior to the decline and rally in 2020 for reference. Basically, every line that you see here on this chart denotes distribution. What I'm going to point out here is the stalling or churning action. That's much harder to see. So starting with this first down week here, you can see, as we were just discussing, you start, you're actually at a new high for that index. That day it ultimately reverses, closes on lows, and slightly negative as volume picks up. Volume picks up again. It's not above average. However, it picks up from the day before. So that counts. That's a distribution day. The next one is your typical, red distribution day. There's nothing subtle about that. Let's just take a look at our next couple that I want to point out here. Here's our next stalling or churning day, what Bill calls, big pickup in volume with little price progress. You can see, again, you were through the prior day's highs there, but ultimately, even though the day finishes just slightly positive, you're closing near the lows of the day, ultimately by the end of the day. And once again, volume picks up, letting you know that it's not as simple as looking at that and saying, oh, we've got an up day on bigger volume. That's accumulation. It's not. That's a distribution day. And one more we're going to mark out here. I'm not going to go through the big down days on red volume. That's very easy to see, but I just want to point out again, once again, here we're making highs along the way. And, so now we're really starting to pick up a fair amount of distribution days in a short amount of time. At this point, just, the idea and why you're looking at distribution days, you're only counting distribution days while a market is an uptrend. And when they become, not necessarily concerning, but they might raise a yellow flag saying, hey, look at me, it's time to start keeping track. When you start to see them piling up piling up in clusters a little bit. And you can see, even, this is subtle as this may be, but again, this is a clear stalling or churning day again, and it doesn't take thank you very much there. Right there, and within a few days you get a gap up to highs, but lo and behold, it doesn't take long for the next few big red distribution days to show up as this thing just blows apart below its 50 and 65 exponential moving average and fall into a steep correction. Here we are now, we're looking at the S&P 500 during that same time period. This is just the distribution count just prior to the February 2020 correction. We're not going to go through on a daily basis. The whole point here is you can see that just prior to the actual top where the big distribution shows up and the market falls into a steep correction, we start to really pick up and cluster distribution in this area here. And as you're looking at that along with the NASDAQ and you're keeping track, you're going to see both distributions start to cluster up around the same time. And, that will lead you to look at other things, so on and so forth. But the idea is when you start to see distribution clusters on both major indexes like that, it's time to raise the yellow warning flags and start looking over your shoulders and see what's going on out there. Look at rotation. Again, as I'll always tell you, the health and breadth of the leadership. What's everything doing? Where is it in its overall cycle? So it's telling you it's time to look.
All right, so moving on to another way to identify distribution, and this is most likely the reason you'll sell out of most of your positions. And on an individual stock basis, that's breaking key moving averages. So this is Coop. I think we talked about this stock earlier on. We see a nice bunch up of key moving averages, another launching pad. Then throughout this uptrend, it finds support at those key moving averages. And then ultimately here, we see a first major break of the 65 EMA. It actually closes just above it there, but then it follows through to the downside and starts the spacing period. There's also another thing going on here. We've got a breakout that ultimately fails. You have a very poor closing range here, and then that starts this downtrend. But the key thing to focus on here is you stayed in this uptrend by following the key moving averages, and then it basically forces you out right here, whether using the more shorter term moving averages or if you bought it right coming out of the prior all-time high around this breakout zone, you can let the moving averages force you out. And although you do end the trade on a sour note, you played that stock and got the most out of it as possible while staying with the trend. So again, the key thing to look out for is look to the left. What key moving averages had it been respecting? Is it still currently respecting those key moving averages? Or potentially, are there kind of distribution signs piling up? Large breaks down on high volume, poor closing ranges, and has the character of the stock changed? And a key way to identify that is the stock breaking key moving averages that back in the uptrend it had been respecting? So that's really what you want to look out for.
Yeah. Just to add to what Richard is saying, what we see is, the stock goes through a basing period, which is basically this, where there's very little respect for the moving averages, right? We're trading up and down, which is basically what base building is. Base building is in motion on the charts where we're either getting ready for an uptrend or the stock completely dies out. Stocks that start respecting the moving averages again, which is basically what we see right at this point on, it starts respecting it. And then we see some sort of, disrespect for the shorter frames, but holds the longer frames. If you're a long stock from this point, you give it the benefit of doubt to see if it holds this longer term moving average or even the 65 EMA. And then when a stock starts breaking the key moving average, which is the 65 here, one close, two close, three close, basically it's losing its trend. And the rule that we have, especially if depending on the cushion that you build out from a proper entry area, is if you get two closes below the 50-day or the 65 EMA, that's usually a sign that the stock's going to go into a deeper, basically forming out a new base. And then what we would want to see before it moves on is the same characteristic again. Either, the market is either causing this or rotation is causing this, but whatever it is, it will build that respect for key moving average somewhere down the line if it wants to trend up higher. And you sort of have to wait for that similar, the RS to show up, the KMA respect to show up, and this launching pad, which is the bunch up of the key moving averages to show up so that you could maybe reposition into that stock. The exit points are when the key moving averages are broken and we see two closes below the 50 and the 65 EMA.
Before we get started, I would say this, as far as climax tops go, there's a lot of times you'll see a stock break out and have this straight up, crazy type of climax action, I guess you could say. And I'm starting off here because I know a lot in the many, many times I've heard, whether it had been, institutional clients or people on the road when we were at workshops asking about, is this stock at a climax top? Is this a climax top? I'm going to tell you 90% of the time, the reason it wasn't is because it wasn't far enough away from its original breakout to be an actual climax. So one of the most important things to keep in mind, the rule in the book says at least 18 weeks from its original breakout, or it's not a climax top. So that's, it may have, and there I've seen the cases where it will have literally every other characteristics of a climax top, the big exhaustion gaps, 5 out of 8 days, one of the, its biggest gap and run, huge volume, largest weekly spread, but it was only, let's say, 11 or 12 weeks out of its original breakout, and Bill will tell you, nope, doesn't count. So I would just say that. I would tell you, what I've seen, and what you will think and swear should be. It will have every single one of those characteristics. But if it doesn't meet that one, if it's not far enough away from it, the idea here is is finding a stock that has really made a move and then gone vertical, something that's gone up 5 to 10 times. And then after that, goes on this crazy vertical exhaustive run. So, and I'm going to say it's not something that it's not common, but it's common enough to understand and be able to spot. And you can, as with experience, you can learn to do some proactive selling into that strength. So that being said, that's why we have the base stages marked: stage 1, stage 2, as we know from discussing earlier. Breakouts from stage 1 and 2 bases are your best bet. They have the highest probabilities of working. As we come further along, we're stage 3 base. This is where I'd say most of your CanSlim and and as well as the institutions become interested, because now it's more liquid. You're looking at a stock, priced in the 40s, and it's not a problem to be able to really invest, put some money away into these things. Although I will say it is a Chinese stock, which will tend to scare away plenty of institutions on a relative basis, all things given, except that headquarters isn't in China. We'll just say that. I think there's a lot of institutions out there that just prefer to stay away altogether. Anyway, I digress. So we see after this 3rd stage base, we break out and we really go on a powerful, almost a climax move. I guess if you were to ask here, I'd still tell you, from this breakout, you're not far enough to be, at a climax, but you can see we've got another short consolidation here. I'm not counting days and weeks, but I don't think that looks long enough to be a proper base. However, it is a constructive consolidation at a glance. And now you're looking at a stock that started off, and it's tough for me to see, but back in the, is this teens, the 12s and teens. So roughly $13 and runs up roughly tenfold. It looks like it tops out roughly $140. So you're looking at so even here from, you're looking at almost a tenfold move from 13, and now the stock explodes from, 80 to 140 in about a week. So, and that really starts to, that's what you're looking for, is that after a huge move, this straight up explosive, straight up move, widest. If you're to look at this on a weekly chart, this is going to clearly be your widest weekly spread. And this, we're not looking at a whole bunch of tops here, but that has the, it's late stage. It's after a huge move already. Here's your largest, as you see, our largest 1-day point gain, and then that ultimately fails and reverses, and that's the top of your stock. So
Ross, would you be a seller of strength on these days, or would you wait for weakness, something like a 141 bar going all the way down to 120? Would you wait for that reversal to happen?
If I really, honestly, Ray, if I really thought that I was catching a stock that was, really truly in the middle of a potential at a climax move, I'd go to my model books of, my climax tops and start going, how many days was this about, and how far did it get above its short-term moving averages? And yeah, I would, and sometimes, I'm early, and I've definitely been guilty of selling too early and then probably trying to buy a little back off a day or two off the high to give back a little bit more money. I've never really, but yes, I will try it. If I really believe that I'm in the middle of, that sort of action, I will be proactively at least trying to sell some. But I know me, like I always say, I like to wait for, you don't want to wait for a stock that's in the middle of a climax move to really force you out to end on a really ugly note, as we say. So yeah, when that thing starts turning red, let's say, and undercutting, that day prior, and volumes probably churning at a tremendous rate, yeah, that would probably be my final puke day. But I would yes, I would be, if I believed I was in the middle of an actual, textbook climax move, I would attempt to be selling, let's say 4 or 5, let's say the average one is, goes 4 to, I don't know, I'll make it up, 5 to 8 days is that climax, of the gap ups runs. And, maybe, so let's say day 5, 6, 6, 7, I'm starting to sell a little bit as I look for that, reversal to, when that reversal comes, if you have a lot of stock, you better be careful.
And Ross, how would you manage your stop loss on the way up during a potential climactic action like that? Would you put it at the low of the prior day, or even the low of the week? How would you manage that stop so you make sure that you're at least getting something out of the trade?
I know I like doing things in pieces, so I might do some at the low of the prior day, and then depending whether it was the next day or the 10-day moving average, or I might, if I'm getting, if it's truly a big position and I'm really trying to play, I'll put up all kinds of short-term exponential moving averages and try and figure out what this stock specifically respects. And I will make a plan depending on how much I have left at what average, what have I sold proactively already, hopefully not. Oftentimes I find myself probably selling too much, not wanting to get caught in that red day. I would say my flaw is getting too far ahead of that red day, scared of getting caught in the, oh my gosh, I got to sell a whole chunk of stock at the market and finish making that red stick. I hate doing that. But anyway, I don't know. So yeah, I'll make point demarcation based on my average, what I have left, what I've already sold, whether, starting with, yes, probably the low from the day before, and then maybe the day before that. And then as we get in towards that, whether it be the 4-day exponential or the 8-day exponential moving average that this stock may respect, I might make, depending on how liquid it is and how much respect it's had, is this something that, just loves that average? And when it falls below, I can say, 8 times out of 10, it's, I'm going to be able to buy it back cheaper. I'll say goodbye. It just depends. So here we are looking at late stage bases. So why is that? So this just goes back to the entire life cycle of a stock. From earlier in the our discussion, we looked at just counting base stages and how a stage 1 base and a stage 2 are considered your earlier stage bases with the highest chance of success of a breakout working. As you get towards stage 3 and stage 4, your probabilities of failure start to increase much more so by stage 4. And it doesn't always have to happen that way. Like, there's plenty of stocks, as we know from, Amazon eventually recovered. We can go through tons of them out there, Apple, Microsoft, Cisco. It doesn't matter. It's not that every stock only goes through 4 stages and that's the end, but very often, the majority of growth stocks, stage 3 and stage 4 will tend to be more failure prone and need to do a little more sideways action before continuing on again. So knowing that and understanding that, it's not, again, none of this is magic. It's not at this number you sell and it's going to work. It may go on, it may not, but this is another way to manage risk and start to understand where a stock is in its overall life cycle, especially, again, not only itself, but what are the stocks in its group doing, that whole sort of thing. Do you have a group of stocks that's maturing, or is this one outside the realm of the rest of the group, that sort of thing. But at the end of the day, late stage bases are where you want to start being careful. In this case, you've had a stage 4 base breakout work in a massive way here. You have a huge run up. I'm definitely looking over my shoulders here as we're building this stage 5 base, which just happens to be super steep. It whips right back out to new highs without really much consolidation. its breakout to new highs almost immediately fails and breaks below its major moving averages. So right there is, to me, that's a major sell signal if I'm lucky enough to still be long the stock from earlier. And let's say I hadn't sold prior somewhere in here and was still holding on after it breaks this late in a move and failing after this sort of powering through. That's, to me, that's it. In this particular case, that's an easy sell signal. The price and volume action is screaming ugly, not to mention that when you've got a stage 5 after a move this big, you're lucky to have gotten that far. Just leave it there.
So one of the last topics that we want to cover for this course, and this was really a late addition, is what's improper in terms of, what's a leadership stock that has the, leadership blueprints versus stocks that are exhibiting emotion on a day-to-day basis. So I'll be going over 2 examples just to show you guys, in the markets, you want to trade based on your risk appetite and what the chart's really trying to tell you, rather than what you think the story might be, or what the chart is not, saying at the moment. So first example we have here is DKNG. DKNG, even though, again, it's important that even though the market was moving lower, which is the dotted line, which is the SPX, and DKNG was showing RS, but not all RS is created equally. The fact that DKNG was in wider ranges, which is 15%, 25%, 22%, it makes it really hard for us as traders to actually manage risk and go about it that way. So even though at some point, every leadership stock that wants to trend is accumulated by institutions on, many weeks and many months, to a point where right before it breaks out, it will really tighten up, the volume will dry up, and it will make it really obvious before it takes that journey all the way up, which is exactly what we don't see on this DKNG. Even though it's showing RS while the market was under pressure, the ranges simply at 15%, 25%, and 22% are way too wide to even define risk. So this is what makes it, this is what makes DKNG a improper chart, and something that, just because a stock is showing RS doesn't mean you close your eyes and buy it. There are other qualities such as tightening ranges. Is the supply being absorbed? Is there a dry up in volume? Are there tight areas on the chart? That all of that, as a recipe, has to come together for you to be in a stock that is going to be a leader for many weeks to months or many earning cycles in a row. The second example that I'm going to cover is UPST. Again, earlier in this webinar, we covered ZS, which gapped up on big volume, had a high closing range, and then had 2 inside days where the supply was being absorbed. That was fairly proper after such a big volume move. Just to cover an example that isn't proper is UPST. It gaps up on, very large volume. This was the highest volume since IPO. It was on a earnings catalyst, but what we want to see after the fact is tightening action so that we could define risk, so that this chart can be considered a proper chart that has leadership blueprints. But in this case, what UPST ends up doing is, it keeps going with a 35% range of the very next day, and then it declines 30% in a single session. Those type of characteristics are not what leadership stocks tend to be doing. Earlier in the webinar where we covered ZS, which was a little bit more proper, it tightens up, volume dries up, there are tight areas, you could define your risk fairly well to position in that stock. Whereas something like a UPST with 35% ranges in a single session, those are not leadership blueprints that we're looking for in the markets. Even after the fact, where it basically moves up and down 30%, the ranges still remain very, very wide at 22% and 24%. So real leadership, just to hit the point home, is going to tighten up. It's going to be in it won't be in 35% ranges. It will allow you to define risk. It will show as many blueprints as we've discussed in this course, where all of those things such as tight areas, pocket pivots, step up in daily average volume, KMAs bunching up would all line up to give you a stock that is considered a leadership stock. To summarize this last slide, again, what we've discussed in terms of identifying distribution on the charts is, from an index point of view, we want to see, we discussed what distribution days look like. Not all distribution days look the same or down, so the closing range matters. We discussed what climax tops in terms of GSX and what late stage base failure looks like in this section. And then the very last thing is leadership will tighten up and show many characteristics that we discussed in the course, and not just show one of them, which may be RS in this case, or a big volume gap up. We need tight areas, tight ranges to define our risk.
And with that said, on behalf of myself, Ross, and Ray, and the rest of Chairline, congratulations on completing the Leadership Blueprints course. I know we've thrown a lot of knowledge at you, but the key thing is to go out there, apply it, look at charts, find those potential true market leaders and model book stocks. And when you need to, come back, redo the modules, rewatch the webinars, and just keep building that cycle of learning and applying what you've learned until it's really cemented in your brain. So feel free to reach back out on our social media platforms, Twitter, YouTube, Facebook, and also make sure to fill out the feedback form to help us improve ourselves, make better courses in the future, and let us also know kind of what you'd like to see from the future of TL University. So thanks again. And yeah, thanks for doing the Leadership Blueprints course. Congratulations.